Hi everybody, Jeff Yastine here. I'm super excited to talk to you today. It's Inauguration Day as I'm taping this, and there's a post-inauguration stock play. Man, I've been watching this thing for a while, and frankly I expected it to break out a long time ago, 2 months ago to be exact, and instead we've had to wait. I've had to wait. So it's finally breaking out now, and I want to tell you about it because I think it'll give you some ideas on how I think about things. Before I tell you the stock, make sure to subscribe to my YouTube channel. Just hit that big red button. We just broke my channel off from the main Wealth Press YouTube channel. I'd love to get more subscribers going there. And of course, follow me on Twitter and on Facebook. I'm posting ideas there on a pretty regular basis as well. Okay, so I want to tell you about a stock now that Joe Biden has officially gone into the White House here. This stock is beginning to break out. I think it's just the start of a big move. The name of the stock is right here. It's eHealth, symbol EHTH. So here it is. And if I zoom in, you'll start seeing why I think this is one worth looking at. As I'm taping this, the stock's up about 9% here on January 20th. So there's a backstory behind this that I just want to tell you about for a moment. So back in on election night in November, I did a paid subscriber presentation for for the folks watching us via streaming video that night. And I basically said, here are a group of stocks that I think are destined to do well, regardless of who gets in the White House, but for particular reasons, trade policy, etc. This one might be a Trump stock versus another one might be a Biden stock. What's interesting is every stock that I talked about that night has gone up substantially, except for eHealth, which obviously is starting to break out today. So I gave everybody Fluor, which at the time was a $13 stock. It's up 60% since then. I talked about Regions Financial, up 30%. I talked about Hewlett-Packard, HPQ, that one's up 30%. I talked about 3D Systems, 3D printing, additive manufacturing. That stock's up 380% since election night. I talked about Vera Mobility, which they help cities and municipalities collect tolls for highways and that sort of thing. So it's like a post-recovery play. That one's up 40%. I talked about Option Care Health, like a health play, presuming Biden would win, which he did, of course, up 26%. CVS, another one, health play, up about 27%, which then gets us to eHealth, which really hasn't done much since I first mentioned it. Now, eHealth is a platform company. They run a software system that insurance companies can use to sell insurance, health insurance, to consumers and businesses. So it's a good way, an efficient way to compare pricing for all these plans. And all of you know how complex and crazy some of this stuff can get. So this is a closer look at eHealth. And right down here, that's election night. And you can see that the stock essentially has gone sideways between roughly $80 a share and about $66 a share through through the last 2 months or so. So now it comes to Inauguration Day, and you have this nice spike here. Again, the shares are up 9%, but it's still below its 200-day moving average. So why would I think then, if I widen this out all the way, why would I think that this stock is about to break through, and not today, but in coming days, through its 200-day moving average, and eventually I think we'll get back to its all-time highs over the next year to year and a half? Well, we can look at that or get a sense of that by looking at what analysts expect the company to earn over the coming year. And I can do that by punching up my overview section here, and I go to earnings per share, and here you go. So for 2020, which those results have not been reported yet, analysts expect the company to earn $4 a share in profits for the quarter and $4.21 a share for the year. Then for 2021, they expect profits of nearly $5.50 a share for the year, and then they expect that to rise next year to $7.82 a share for the year. Now, that's frankly really good profit growth, and I think that the company is on solid footing in that regard. And the other thing that I usually do is I use a very simple measure of value of a stock. It's called a price earnings ratio. Analysts sometimes call it a multiple, a price earnings multiple. So how do we handle all this stuff regarding multiples? Well, if I bring up my calculator here, we know that the stock is trading at $78 a share today. We also know that the company appears to be on track to earn $5.48 a share in profits for 2021. So we take 78, we divide it by $5.48 a share in profits, and that gives us a price earnings ratio of 14. So then it's sort of like, all right, that's what we know now, that's what the value that's reflected in the stock, such as it is, right? So then you look at the 2022 earnings estimate, which is $7.82, and we basically just do this calculation in reverse. So $7.82 in profits times that PE ratio or multiple of 14, and we get a stock price of, let's say, $110 just to round it off, which is sort of, if investors are valuing the stock the same a year from now as they do now, then we're looking at a stock price of $110, which is, I'll give you the exact number on that, which basically is a rise of 40% in the shares of the stock over the coming year. And my opinion is that I think the stock is going to do that and more. And the reason why I say there's the possibility of more, no guarantees on these sorts of things. We always have to measure risk and reward, but I'll just say I like the reward compared to the risk of things not going as well for the company. And part of the reason why I like it is because that PE ratio of 14 is historically low for the stock. It's typically traded at a PE ratio of around 20. Okay, so then if it's at a PE ratio of 20, let's say the stock moves higher, Wall Street and investors in general say, hey, maybe there's something behind this ehealth stock. Maybe we shouldn't have been so quick to write it off over the past year as the shares fell lower in value and as various uncertainties weighed on the stock. Well, if they revalue the stock, or what I say is to assign a PE ratio higher on the stock. Well, if it's a PE ratio of 20, we can do that by saying 20 times next year's profits of $7.82 a share. Again, presuming it executes properly and gets to that level. Now we're looking at a stock price of $156 a share sometime in the next year to 18 months. And of course, that's basically a double from the current price of the stock. So that's just a look at my method of how I think about stocks. So my colleague Roger Scott calls my method a fusion method, and he's exactly correct, because I like to look at the technical analysis end of things and look for patterns like breakout patterns, and there's other internal technical indicators that I like to watch. But then I will also go and look at the fundamental side of a company and look underneath to actually see the business, explore the business, and see, well, what is going on there that might carry the stock much higher beyond, say, the next day, the next week, the next month, but the kind of stock that you might own for 3 months, 6 months, a year, and hopefully see a double or better as we are analyzing the risk and the reward properly on a stock. So eHealth, symbol EHTH, I think that's one to look at. It's making a nice breakout today, Inauguration Day, and I think, in my opinion, I think it's likely to move higher from here. If you like what I'm talking about, again, make sure to subscribe to my YouTube channel, follow me on Twitter and Facebook, And until next time, I'm Jeff Yastine.